Hey YouTube, this is Zach with Achilles Financial. Today I'm going to be talking about Alibaba Group, and they trade on the New York Stock Exchange under the ticker symbol BABA, B-A-B-A. The reason why I want to talk about this company is because they have been on a very consistent downtrend over the course of this calendar year, largely due to regulatory pressure. Now, that being said, I think that there's a significant amount of potential for this company long term, as they have a significant amount of the market share in China, which is one of the fastest growing economies in the world. Now, some of the things that I want to highlight first and foremost is the fact that this is a company that is still growing annually right at 30% on an annual basis. This is incredible growth. The other thing is that the CEO just said that they were going to step up their total buybacks to a total of $15 billion. Generally speaking, when you see CEOs of companies and the board approving share buyback plans, it tends to bode well for the stock. Now, we talked about this today. We didn't catch it on the bottom. If you look at the daily chart, not necessarily the 1 year, but if you look on the daily chart, they had a rough morning. I did not catch it here. I did buy in around the 158, and they continued rising today even after hours. So they continue to climb, and I still think that there's a lot of long-term potential. So the CEO, Daniel Zhang, is incessantly buying back the company stock right now, and I think that that will continue despite the fact that, again, there is regulatory pressure. The CEO believes that this is going to be a good long-term purchase and is going to benefit shareholders. You can see that they did actually hit that 1 week low today. So the first thing that I want to highlight, other than the share buyback plan, is if you look at the growth associated with the company. So what we'll do is we'll click here on the valuation and we'll look at the growth rates. I want to highlight the revenue growth trailing 12 months. So the earning per share growth on a trailing 12-month basis has dropped, and that is associated with the fact that the company had a lot of impacts associated with the COVID fiasco, and for that reason you saw earnings or profit decline. However, the company is very profitable, and you can see year over year on the trailing 12 month as of last quarter end, they grew 40%. Now, the reason why this is so impressive is because this is not a smaller company. This is a company that serves an economy of 1.2 billion people with nearly 900 million active users. So this is massive scale, and the fact they're growing this quickly is a huge deal. The other thing that I would highlight is not only are they growing, but they're growing very profitably. Now, one of the things that's driving such high growth here is they are the leading provider of cloud software in China. So not only are they bringing 40 cents to every dollar straight in as gross profit, but even after all of that, they are still walking away with 16.5% net profit margin. So not only is the company growing incredibly quickly, but they're growing up very, very fast. And not only while they're doing that, they're doing so at a profitable rate. So let's put some of those numbers into perspective. Recognizing that the company has fallen way off of last year's high of $319 a share, you can see that right now they've got a price to earnings ratio of 19. I want you to compare that to other high flyers such as an Amazon, such as Shopify, such as Google. All of those companies are in the 30s to as high as 70s. So those are high growth companies that are doing so profitably, trading at much higher valuations. And you can see that the pain that's being inflicted on this company right now is largely due to the Chinese regulatory pressures going on right now. The first thing I would also highlight is the price to sales of 3.63, but the massive one right now is the price to cash flow. We're talking free cash flow right now. A 15.84 at these levels is ridiculous. So this is 13x non-GAAP earnings, which is insane for the largest growth engine in the world right now. Again, this is the Chinese version of Google when it comes to the cloud marketplace. You can see a number of their segments and capabilities here. They have more than 900 million active users, and they're growing this EPS on a year-by-year basis very strong. So you can see right here, we have that cash from operations, $231 million, and that was in 2021, their fiscal year. What I'll also highlight when we look at this income statement right here of the total net income 2021 to 2020, again covering the pandemic, was nearly flat. But the idea of those flat numbers when we look at straight revenue is $717 billion, which is absolutely insane from that total growth. But what we'll focus on is that total net income, which again is being used to buy back stock shares as well, of $150 billion in profit. So there's a lot to like about the company. This is one that is going to continue to grow, and I want exposure to the sector. My only other Chinese holding right now is NetEase, which has had a strong first half of the year before falling off in the second half of the year. So there's a significant amount of capability for the company to continue to grow. Now, when you look at some of that insider trading, then we're not going to have a lot of information available here in the platform. But what we will be able to see is the price targets that have been set aside at this point in time. So you can see that there's over 23 analysts who are currently looking at the stock, with the vast majority, or really all of them, holding a price target currently higher than where we're at, and not just by a small margin, but nearly $30 at that low end of the 190. Now, keep in mind that analyst price targets are, generally speaking, just as good as what I'm throwing out there in terms of we look at a stock, see the potential moves, and then throw money at it. Now, what I would once again highlight is that the consumers currently in Alibaba's ecosystem is 1.2 billion, and that's up since we saw March quarter. That's up now in the June quarter that we're going to be looking at. And again, that user base is with 900 million of them in China, where we've seen a massive increase in what is now the middle class. So with all of the capabilities associated with this company and with all of the growth associated with it, it leads itself to be seen that there is exposure, there is an investment here, and I want to make sure that I have the capability to play in that market, despite the fact there is going to be a lot of regulatory concentration surrounding how much power do we want to give private industry in China. That being said, it's one of those things that I want to make sure that I still have some exposure, but I recognize that the potential risk is still there. But you can see that the stock was over $300 a share nearly a year ago, and I think that while $300 a share by the end of this year probably isn't in the cards, I do like the idea of being closer to the 185 to 190 range, because the company continues to post very, very strong numbers, despite the fact that they have really tough restrictions from a regulatory reporting capability. So all of this is the reason why I believe that why I personally have invested into Baba, and why I think that there is a lot of potential going forward. So if you have any questions, feel free to drop those in the comment section down below. Or if you want to see my trade, I made that in the Discord, which is in the description. So let me know, and if you found this content helpful, please leave a like and subscribe. Thanks. Talk to you later.